Hey guys, Freaky Finance here. Anyway, it's starting to become a holiday season. I know Americans have Thanksgiving this weekend. For me, it's kind of the lull in earnings season. It's kind of like the end of the big earnings season, and I just have the Canadian banks at the very end next week. So today, it's more for me of a review. It's kind of like what I like to do at the end of each quarter is I go through my notes and I kind of think of where we're at. And today it's going to be that process. So instead of one company, it's kind of a mosaic of all companies. And I guess I'll start more pro and then I'll work my way down. It's going to be a longer video, be less focused. It'll just be more on general themes that I'm seeing and where I think it's going and stuff like that. This is one that I always listen to myself like a quarter from now to see what's going on relative to what I was thinking, what's better, what's worse. So anyway, one of the trends we keep seeing is we continue to see mutual fund outflows, and basically everyone is selling their balance funds. They've done this for about 2 years now. And they've been moving to GICs. So as interest rates in Canada gone up, and in the States we've seen just consistent outflows out of balanced mutual funds in general, but specifically balanced mutual funds, and you see that here. What this means, and why I'm bringing it up, at some point that outflow is going to change, and I think the first thing it's going to go to is back to bonds, and then it'll go through probably to the small cap equities at some point, or maybe they go into large caps or the passives, and the large caps just keep getting larger. I don't really know, but I'd say at some point bonds are going to get a bid. And here's just another way to show the same thing. Basically, you see the rates go up, you see material outflows in mutual funds, and you see that the term deposits in the banks are still trending up. So people are still going into GICs at banks. In terms of rate of change, it's actually decelerated relative to what it was doing for the last 2 years. So one of the things we're starting to see, this is from Capital One. I went back to 2008. This is what 2008 looked like. And basically what I'm doing now is drawing comparisons to where we're at in the credit cycle. We've started to see delinquencies go up and net charge-off go up. What do we mean by that? Go up relative to what, right? So relative to obviously the prior years, but relative to 2008 is more interesting. So we've started to see, so this is Q4 08. So this is right around the time when we started seeing deals. The markets bottomed in 09, March. That was more of the panic part of it. But things were weakening well ahead of that time. And they actually had a 7% charge-off, managed net charge-off rate, that's what Capital One calls it, in Q4. So at the end of December, that was their net charge-off rate. And one of the interesting things is this net charge-off rate just increased from 7 in Q4 all the way up to Q3 2009. You had 9.64. It actually got higher than that. So one of the things you'll be like, well, why did the markets bottom in March? Even though the domestic cards still got worse, credit still tightened even after the market bottomed for credit cards. And part of that was because the markets were in panic mode there for mortgage lending. You can see that on this one. You can see that the peak panic was in Q1 2009 in terms of mortgage credit delinquency, because the panic then was on mortgages. Anyway, the reason why I'm bringing it up today is because it took quite a bit for this 9.64 to work its way down, and technically didn't get back to 7% net charge-off rate until Q4 2010. So what this means in terms of the current amount, currently they're back up to about 7.7% again in net charge-off rates, 7.79 on domestic. That's the latest quarter. So basically, I'm just a long-winded way to say that we're getting back to where we were. It's actually ahead of Q4 2008 in terms of net charge-off rate. We're not yet there in terms of delinquency over 30 days, but we're getting there, and the trend is negative. So what we're starting to see is the credit cycle start to turn, I think. And usually that's when you start seeing spending slow down more. Whether the market's already front-running that or not is a harder thing to tell. And we haven't really seen too much break yet, aside from regional banks last March. And here's just a 30-day delinquency rate. It's 3.71. So yes, it's gone up almost 100 basis points year over year. So it hasn't been a small move up in 30-day delinquency. But we're still not to 2008 levels here, but we are at 2008 levels in terms of net charge-off rate. So they're allowing quite a bit of provisions already as a percent of their lending base. So it's just worth bringing up that we are getting longer in the credit cycle, so it could be pretty quick here. Whether that tightens up even further, it already is tightening, and that's on top of spending tightening in general, because more people are starting to find themselves unemployed, at least in Canada. We'll talk about that as well. I always read Brookfield's commentary each quarter. Here they're saying they expect interest rates are cresting right now. Here's the unemployment rate in Canada. You can see it's already 14% worse than it was 6 months ago. So 5.75, so about 14%, I think, top of my head, more than 10% anyway. Increase unemployment, so there's people having less money next year. And this, I've never really seen soft landing when it goes up as much as it has lately. I think this trend is just going to continue. Like, we just keep seeing layoff notices from most of the major cap Canadian companies. And at the same time, the government of Canada is still saying they're going to hold rates steady, and they're always going to say that right up until they don't. That's always been what they should do if they're trying to manage inflation. I ultimately don't think they will, but I mean, technically, if they do, it just means that you're going to get a severe recession. You can see people will keep arguing online if rates have peaked or not. In terms of inflation, it's peaked almost. It's going to be 2 years ago next summer, so it's it's obviously peaked. Whether they feel it or not, it's a different matter. But in terms of math, it's peaked. One of the things that's keeping it up is actually the interest rates that they've made during the last year. And this is someone, and David Rosenberg, I find him interesting because he always strips out things. This time he strips out mortgage interest, which is actually agree with. Basically is saying the CPI 3.1%, which is for October, just reported for Canada. Basically saying it would be 2.2% if they took out the mortgage interest. Mortgage interest is basically the impact of the increase in rates year over year because they've taken up rates so quickly. As you can see here, it's influencing the inflation reported rate in Canada. It's actually the biggest component of why inflation is still above 3% right now, is because they've raised rates to combat inflation. That's the one's causing the reported inflation as we speak. So it will be happening, I'd say, maybe earlier, but I'm thinking like March, maybe April, is that you're going to start seeing inflation start coming down even quicker. And part of that is because we're finally past the year-over-year comp and the basket noise on the CPI for mortgage interest expense increases because they've started holding rates steadier for a while now. And that's going to become more and more obvious as we go through 2024. So I'm thinking right around, let's say March-ish is when you start seeing a even more material rate of change slowdown in inflation that's reported. And then people will be all shocked that it's actually going down quicker. But honestly, one of the reasons why it's sticky is because the interest rates themselves have gone up so much year over year. And a part of that is because Canada includes it in their CPI, and a part of it's because the rate of change and how quickly they increased it just in a single year also makes it show up more than it otherwise would have. In terms of freight, so we're going to talk about goods. We're going to go through all the companies that I track each quarter. Not all of them, but most of them. Some that I still own, some that I don't own, some that I'll never own. But I like to track them anyway. Anyway, for freight, it's still bad. Load to truck ratio is still worse than 2018, 2019. So things are definitely still recessionary in terms of goods, I would argue, in terms of freight, especially if you were a trucker. And I think that's only continued. In terms of rail's a little bit better. I'd say it's a better business than trucking because you don't get totally killed on the rates as demand drops off. Whereas trucks, you get killed at both the load and the rates at the same time. Mainly because with rail you can't capacity doesn't go up and down as quickly because I mean it's a railroad. You're not going to have somebody build a railroad in a year to compete with you. So anyway, railroads basically take price. It's a nice business. It's actually probably one of the easiest regulated businesses that there is because for some reason they'll kill the pipelines and they'll kill the banks and they'll kill the pharmacies, but regulators seem to not be as I would say critical of railroads. But anyway, railroads, this is CN's. You can see intermodal just getting killed year over year, down 34%. Trucking, just by trucking itself, is even worse. One of the fun things, this is interesting for trains and rail, is that you're actually seeing auto still up year over year. And part of that is supply driven. So the numbers would be even worse year over year if the dealers were still not trying to fill up their lots, in my opinion. And we've also seen rates come down per mile. So we've seen both volumes and rates come down. That was in the last quarter. We're actually seeing the rails take price like they always do. And inflation take price, recession take price. Rail always takes price. We're actually seeing volumes where they're still down year over year. They're not as bad as they were. So it could be stabilizing here, which could be interesting in the future, right? Because the market is forward looking. So that's why I look at rail. And so it makes the decision whether things are going to get worse. I think they will, but how much is that is already priced into the market at certain times, especially in Canada where it's easier to see the end of the cycle, right? The higher for longer argument in Canada is stupid. Anyway, you can see volume still down 4% year over year. In Q4 for CN, they update this each week, I think, or daily, I can't remember, but I check it out. So it's not as bad as the numbers that they just showed in Q3, but they're still bad for Q4. It's not like things are growing when you're shipping 5% less. What else is there? But you can see the rate of change, it does appear to be bottoming anyway, which could be a good sign on the horizon. So that makes it tricky, right? So when you're trying to add to positions, like I said, obviously I like the bond side more, but I mean, that's not as exciting for a video for online for predominantly in equities, as someone younger. So what do? I try to find companies that were getting killed because interest rates are high, because everyone's buying GICs. Dividends aren't as attractive. Dividend companies are going down. So those are the ones that you start buying. So that's what I was doing in October and before that. But I've been basically buying more defensives, especially the Canadian utilities and Canadian pipelines. And you'll see that. I'll probably do a video on current positions, but maybe I'll just flash a few, but we won't go. I'm going to take another video and just go through all the positions that I have. And I'll probably do like a cross-section because I like to look at my current holdings before I go into the next year. And I kind of see what I'm thinking and how things are actually going to play out, because I actually don't know. I just think, right? But one of the things I did want to point out is you can see Enbridge or E-split. It's just a covered call way to play Enbridge. It's a decent sized position now. Again, it's just that I see them as more defensive, interest rate sensitive, like pipelines. What else is more of a interest rate? So I'm starting to pick up. Maybe I'll do a video on Bank of Nova Scotia after they report earnings next week. I still think they'll be bad. Brookfield is just another interest sensitive play that I like, so I started picking that one up. Again, E-split, Enbridge, TransCanada Energy picked that up. Superior, another interest rate sensitive one. Algonquin, Atco, the more interest rate ones. BMO, Bank of Nova Scotia. Again, things are getting cheaper, so I still think we'll get cheaper from here. But I've just started to add to them. And the idea isn't to time the bottom, it's just to get in at what you know as a relative value for long-term hold, right? These businesses are already getting cheaper than they otherwise would have been if we were not into rolling recessions like we are now. Whether people call it a recession or not, it's been obviously we've seen certain sectors go into recessions during the last year, and it's leading to some interesting prices. But that doesn't mean they can't stay cheap for longer. Anyway, that's kind of what I wanted to show. I'll go through those ones at some point. So let's actually jump through the numbers, or not through the numbers, but through kind of what I'm seeing in each company. So basically how I do it is mosaic, and I kind of take notes as I go during each day. So this is for the Q3 quarter. So basically I do some prep stuff, and then basically from September right till now, middle of November, near the end of November, is earnings season. What I should do first is just go through the banks, because the banks are important for the next bit here. Some banks are still lending quite well, some have slowed down, so we are seeing tightening in terms of rate of change in lending. At the same time, though, some of the banks, not Canada anymore, Canada started to cut headcount finally, but in America they've been slow to reduce headcount, even though obviously lending's slowing. And we're also seeing deposits slow finally, even at JP Morgan, which was the big recipient from the regional banking crisis in March 2023. And here they're saying that this is back a couple months ago now, but they're saying inflation remains elevated, interest rates are rise hard from here. And that was the consensus, higher for longer. And everyone's still pitching that. But if they actually want higher for longer, it means a recession, more severe, for shorter, I guess. That's how I see it. Anyway, Citibank, kind of the same thing. You can see lending is slowed, and deposits are in decline. Seeing cracks in the lower FICO customers. EU and UK is pretty negative, and CEOs are less optimistic than a few months ago. All right, then we got Wells Fargo. Actually had decent loan yield growth, but it's seeing loans itself and volumes decline. Loans are resetting higher, and it's outweighing those decline in loans outstanding. One of the things, I should do a bank. Maybe I'll do BNS after. A lot of people avoid banks because they view them as complicated, but But the NIM here is basically the spread between what they make on lending versus what they have to pay out in deposits. One of the things most textbooks would say higher interest rate environment, or as rates increase, actually helps banks, and that's normally true. But one of the things that happened this time is because rates increased so quickly, we saw the deposit side, the liability side of the banks, re-rate higher quicker. And so, whereas the lending side has to slowly, as the lending comes due again, they refinance, then they get that extra pickup. And so, one of the things that happened is because rates shot up so quickly, all the deposits went to higher depositing interest rates, what hurts the bank because they have to pay that. And then on the other side, they didn't get that step up. They only get it gradually over time based on whatever the loan dynamic is. Obviously, it depends on the bank, but that's most banks would have had a lagging pickup on the asset side, the loan side for them. Loan for a bank is actually an asset because they're lending to you. Anyway, so Wells is actually ahead of the game for cutting headcount. In the States, we've seen most. We've already seen most of the banks in Canada start cutting headcount. Some have been doing it more under the surface and some have made headline news. But most of them are now cutting headcount, which they should be doing because we've seen lending slow down so much. And that's not just, it is a mortgage, but it's also in auto. Basically, the bigger ticket places we've seen material slow down. So why do you need as many people when you're not originating as many loans? Most are saying the same thing. Goldman Sachs, that's more investment banking side. But you're still seeing net, so you're seeing year to date down still less debt issuance. People are trying to avoid going to the bank for the higher rates if they can. Eventually that runs out though, then they're going to have to either refinance or go bankrupt. And that's what we're also slowly starting to see, the decrease in bankruptcy. Anyway, on the credit card side, you can still see travel and entertainment still outgrowing year over year versus goods and services. Travel is just relatively still strong. Part of that is because places have opened at different times, and some people are more comfortable traveling or not. I also think the fact that travel was restricted makes travel more, at least from my point of view, people will value that more because it was taken away from them. And I think that might be something generational over time. And the younger generations were already favoring entertainment and travel over goods and material things. So basically, they prioritize experiences over material things, is what I'd argue. And I think COVID has accelerated that. But that's not this. This is literally just COVID mean reversion still playing through. Anyway, credit provisions are all going up. I can say the same for all the banks. They all still need to go up. They're all still, half of them still have a baked in as a soft landing as their base case. Whereas I think it's more likely going to be, no matter what, a soft landing, if not worse. Whereas some still have a thing there that there's things like 20%, things are just going to be fine. Oh my God, every leading indicator says no. Anyway, year over year, network volumes year over year was fine for network volumes at Amex, but the interesting thing with Amex is that Q over Q is actually down, which is interesting because we saw lending increase. So that's kind of unusual at Amex, so that's something I want to see next quarter. I talked about Capital One. Synchrony, it's the same thing. You're just seeing up and to the right in terms of net charge-offs, up and to the right instead of 30 days past due. So things are getting tighter. People are paying less frequently, and the companies are starting to write off more of their debt that they lend out. In terms of travel, or Visa rather, similar to Amex, you're seeing still pretty good numbers in terms of travel and cross-border volume, but you are seeing it decel. So even the stronger areas year over year are starting to slow down. All right, so let's go to the actual companies. I'm going to try to go really quick because there's a lot that I follow, and we're already running longer than I wanted, but that was always going to be the case for this one. So I'm going to talk pretty quick, and if I skip over a few or I go too quick, I just want to just pause it and read. Anyway, we'll start with Sportsman. So you're going to see quite a bit of double-digit year-over-year declines in top-line revenue. That's because retail has been in a recession for a while. Some people don't view it that way, but that's how it actually has been for most companies, I would argue. Unless they're doing something special or unique or had a very bad last year as well, that maybe they have an easy comp. Most of them are still putting up double-digit declines on the top line, or at least over 5% declines. So anyway, this company made 12% last year over year in revenue. Did not see store traffic improve like they anticipated. E-commerce is doing better, and that ties into Amazon's PayPal's talk. I skipped over that, but that was up here. Basically, they're arguing they're a growth story that's not currently growing, so that's why the multiple is getting smacked. RH, I did a video on this one actually recently. This is honestly from that video. Basically, Buddy bought 17% of the company going into a big book launch for their product. And I just think over time it's just going to play out well. But again, who knows how cheap it gets in the interim because of how weak housing has been, right? This is a play on luxury housing, furnishing. And furnishing has been very bad. And probably even the numbers were pretty bad even for Home Depot and Lowe's, which we'll also touch on. Braid, we'll skip over that for software, but basically we're seeing in software land that still a lot of companies are still hesitant to put capital work. So it's basically extending the sales cycles for software companies. So we've seen software actually got hit pretty hard last year. So we've actually seen some recovery and some bottoming here as things aren't getting worse. In retail, it's hard to know if things are going to get worse or not because the credit cycle would dictate it should. But again, they're already putting up such horrible numbers for so long now that it'll be interesting to see that dynamic play out. And I still own quite a bit of retail that I'm slowly trying to get into as they report reality and get smacked down and pick up more, right? For the next upcycle. Anyway, Kroger, the grocer, still seeing pressured on consumer, especially on tight budget. We also saw SNAP get reduced, so that's also showing up. And in October, we saw student loans no longer be absolved of, so or whatever. So they're starting to show up. So that's also going to put more pressure. In Canada, we just saw that they're coming after all the CERB overpayments that they paid out. So they're also clawing back that at the same time. Interest rates are higher, and all the people are feeling more pressure because of the inflation that they created. So anyway, there's a lot of things that are hurting consumption right now. And in terms of rate of change, it's going to be hard to do worse than that. But they still have to report the current reality. And I think the current reality is still not being reported in expectations or in guidance for a lot of companies. Bowler, this is like a tuck-in play for bowling. It's actually kind of fun one to read through. Maybe I'll do a video on it just because it's entertaining, but it's never cheap enough to actually own, at least not for me. Anyway, consumer spending still softening because the consumer spending cheap value, and you see them going to $2 Tuesdays that you can bowl. So that everything, one of the things that we saw over the last, I want to say 9 months now, is consumers are responding to deals and value or promotions. So, and that's just another example here. All right, basically, there's Bank of America saying consumers are starting to pay down debt, especially credit cards, at a faster rate. They argue customers protect themselves from the credit cycle. I don't know if I've ever seen that. Most of the time they they try to, but usually there's a reason why they have to keep borrowing in order to sustain their current borrowing. What else is there? Tobacco, soft, so Casey's are up 26% in the same store private label, unit volume up 16. So one of the things is kind of interesting that we see on the retail side is that as customers trade down because things are bad, people are buying the private label items. So think of like the Great Value Walmart. We've seen this for over a year now. What else? Roots still seeing challenging conditions. Revenue's only down 3.5%. I mean, only down. They mentioned softness in demand for fleece bottoms. CVS basically saying the pharmacy business is still struggling. Retail business guidance as well as consumer softening from demand. They also expect less COVID contribution. Pharmacy business in the States is very bad. Basically, how it's structured is that the Americans want most of the pharmacies to go bankrupt, except for maybe Walgreens and CVS. And CVS partially hedges itself by owning BPM, whereas Walgreens does not. So anyway, that's something that needs to reverse at some point, or else there won't be very many pharmacies left in the States. But they're still reporting reality. And the retail foot traffic continues to be weak. And they're also getting smacked by COVID reimbursement pressure, and then they're also getting smacked by higher wages for their sales staff. So basically, that's why Rite Aid is bankrupt now, right? Things aren't exactly great there either. This is on the Goldman Sachs conference for Walmart. Walmart basically said general merch prices are coming down. That's good for inflation as it's going down, but it's not good for Walmart itself. But they believe customers are going to see relief, and Nash reported that as well. We know that later on. Again, this is during September, and we are in the end of November now almost. RBCs, this is right after they reported last time, and they said that they're going to cut 2% of their headcount and a further reduction of 1 to 2%. So about 3% probably in headcount reduction. The comment here is before Scotia announced they're also cutting 3% of their headcount. So the Canadian banks are starting to cut headcount. Here they're basically saying that without the population influx, GDP would already be contracting in Canada, so we'd already be in a recession without people coming in, and that we should start seeing unemployment start spiking. Saying Canadians have saved up more during the pandemic, but I mean, Canadians going into the pandemic were in actually that good shape in terms of their balance sheets. What else is there? Home Depot was talking about how they over-earned in the early pandemic. There's still pressure on larger ticket projects. And we saw that with Lowe's and Home Depot. They both said that there's still pressure, especially on the do-it-yourself side. Here people are the WBD, so Warner Bros. Basically saying this notion of 18 months rolling recession, especially, that never really happened. But if we just go through the numbers of the last 18 months for some guys, it's definitely happened. It's not normal to lose 20% of your business year over year, right? Or even 12% for sportsmen. And we'll see worse numbers in other retailers as we go. But their numbers weren't good. PayPal is interesting. So this one, they're cutting costs on the operating side to offset transaction margin. One of the things, PayPal's having a fight with Stripe and other processors for volume. PayPal basically charges a higher margin than his Braintree business does, which is on-branded business. Basically, it's outgrowing on Braintree, which is hurting its sales mix, as it technically, in my view, cannibalizes the PayPal branded button. Now, I own PayPal as one of the risks, but because it is growing, I mean, it's 10 times free cash flow, growing 20% EPS a year. One of the problems with that, though, is it doesn't know how far out you can keep cutting costs to keep up that transaction margin, and the management team fails to actually guide to what their transaction margin will actually bottom at. They don't know. So that's the why it's cheaper. Once they say that, well, it's going to get better from here kind of thing on the transaction margin, PayPal will re-rate. But until then, and we don't know that it actually will, right, then it'll stay cheap. That's my opinion. What else is there? FedEx, still weak volumes, both in quantity but also weight. A little bit off in decline. So it is still a decline, but it's supposed to be stabilizing. It's still seeing ongoing demand weakness. Basically, FedEx made 9% less money in top line, but they offset it by reducing expenses. Thor, so your RVs, unit shipments down 30% year over year. Market share was still pretty high. It's 49%, but down. They still have a backlog to go through. So the thing is with the RVs is that they'd be even worse if they didn't have a backlog to chew through. But again, we're still down 36% year over year, right? So we've seen the big ticket items get completely crushed, especially at these higher rates. Maybe the stocks haven't, but the actual fundamentals have deteriorated for some of the big guys. One of the fun things with this one is at the same time you're seeing, like I showed you, the travel where auto was still growing. One of the fun things is that we saw that with RV, that they're growing right up to they weren't. So what does that mean? That basically the dealers want the inventory on the lot and they want to fill it up. But as soon as it's full and it's not selling, then it's a problem. They don't seem to realize the fact that auto lending is slowing right now. Why should we keep ordering more cars, even though we know that the days on lots are going to start going up, right? We saw that in RVs, and we're seeing that in boats as well. Anyway, Nike says the inventory is back under control. That usually shows up when margins are no longer declining, and we've actually seen that in retail. Retail has been bad for a while, so we've actually seen them. A lot of them have actually gotten their inventory back in control. So margins are starting to expand. It's just the revenue side that's still getting hit. Carnival beat and raised. We're still seeing the travel side still out and the experiences side still went out. They're not seeing signs of slowing from our customers. So this channel check on the other side still reporting strong numbers. The market's expecting that to weaken. Cormac mentioned that their Asia business is slower to recover than anticipated. We've seen a lot of Asian demand go for Asian goods and stay in Asia spending. So what I mean by that, we'll talk about Tunio and Tor down below, but basically things like Trip.com, they're basically saying domestic travel is actually really good. It's actually better than 2019 levels, whereas international travel is a lot weaker, which basically means the average Chinese person is deciding to spend their travel money inside China and not go out internationally. Anyway, then that could be something here where basically maybe China's buying more of China-made products instead of American or other international companies' products. Similar to what's happening, I'd argue, in the Western world, where they're trying to buy made in America products versus made where it's cheap products. Helen of Troy, so far their expectations are still improvements in gross margin and cash flow. we'll see consumer behavior shifts, elongated volume recovery across the industry. Here's Conagra. So most consumer packaged goods, or quite a few of the strong ones anyway, have been able to push price relatively well. So we've seen things like 12% price increases, but like 4% volume declines. And what that means is basically they raised prices 12%. They lost 4% of the volumes that they normally would have saw, but they're still making that more money. It's actually a decent amount of money because the margins aren't usually that great for food. They can be, but for most of them, they're not. Anyway, so here you can actually see that Conagra was failed to increase price enough to offset volume decline. So here's one where Conagra is obviously losing a private label. And there's obviously more price sensitivity or some type of competition going on with their offering. Here you see Lamb Weston traffic growth slowed. Wasn't too big of a deal there. Here, one of the other things we're seeing is wholesale is getting smoked, whereas a lot of retailers are trying to go direct to consumer themselves and cut out the middleman. And we've seen this trend for quite some time. It also works into with the inventory side. If they're trying to manage inventory, if the inventory is less, they should be trying to go DTC anyway and not have to go to wholesale at all. So that's one of the things we're seeing. What else is there? PepsiCo. So again, they mentioned they're seeing trade down in terms of trade. This is probably a contraindicator to the other side of goodness, is that people were still deciding to buy Pepsi products in convenience stores, right? Which is pretty interesting. They're up 5% in beverages and 8% in foods inside the convenience channel, where convenience is more expensive. So that's kind of interesting to see. LVMH. So we're starting to see it lagged for quite some time actually. The weakness in luxury. So we've seen spirits and wines. We saw Diageo as well after this also report pretty bad numbers in Latin America. And we're seeing that in fashion, specifically wines. We're seeing a slowdown in jewelry. Selective retail is a little bit different because again it has a travel in there with DFS that they own. They also have Sephora in here with Kohl's. What else is there? Walgreens, I already talked about the pharmacies getting smoked. What else is there? Delta kept their guidance. I mentioned their booking still strong, but they're seeing higher fuel and higher maintenance costs. We also know pilots are getting paid more money. It's also influencing the whole industry. Johnson & Johnson, still doing pretty good in terms of their drug business. They have quite a bit of billion-dollar drugs. MedTech still recovering. And they're still fighting the talc case for cancer. What else is there? United Airlines, very similar to Delta, facing sizable headwinds of labor and expectations. Flight attendants. We've seen international do better than domestic in the last 6 months, or maybe this whole year even. So that's interesting. We'll see if that continues. Alright, and then we go back to transportations for J.R. Hunt. So again, trucking, pretty weak. You're seeing a 40% decline in operating income year over year. Revenue's down 15% year over year. Revenue per load's down year over year. So anyway, very bad. You have integrated capacity down on your profit segment. And here they actually call freight in a recession. A lot of companies are afraid to use that word for whatever reason, but it's been a rolling recession for some time in different industries. So I'm actually glad they're using that because that means they're actually going to try to get a handle on it. First step is seeing what's happening and then reacting to it. Anyway, Winnebago, like Thor, you're seeing revenue down 35%, gross profit down 39%, operating income down 53%. Again, you have a weak consumer market, and the Q4 quarter results reflect a stubborn retail environment. They do expect inventory levels to further normalize and consumer demand stabilizes. Inventory is still too high in the dealership channel for RVs, and I expect that to stay up for a while. ASML, semiconductor industry, is currently going through the bottom of the cycle. Semiconductors did actually get impacted quicker, so it would make sense that they get out of it quicker. We'll have to see if that's true or not. Right now they're still putting up some pretty bad numbers on the CPU side. Obviously NVIDIA is a little bit different with data center, with accelerated computing, but we've seen the rest of the guys put up some pretty weak numbers. Tesla, automakers are just getting killed. I shouldn't say all of them, but some of them are. Tesla basically has an inventory problem. It just is producing so much, and well, people are buying them. It's just not enough people buying them. And so we're seeing EBITDA down 24% year over year, EPS cut in half year over year, and you still have inventory up year over year. So they still have to go through this discounting cycle where they have to promote the Tesla cars to sell them at a time where maybe the other automotive manufacturers are also doing the same. We'll have to see. The other automotive manufacturers also have problems of their own. with giving so many other laborers wage increases through unions. That's going to make them very probably unable to compete in the long run with Tesla, but doesn't mean Tesla's a buy. I've read it up once. I might go into it again at some point. Maybe I'll do a video on it, but it's just still too speculative at this time, and I need to see the rate of change inflect positively in terms of inventory, like I would with any other business. Netflix, we're seeing accelerated pay membership growth. And this was interesting because this is when Suits was number one, not even their own, right? It's old content that was re-released on Netflix, and Netflix was able to make it number one. And I think that shows the business strength here, that whatever they decide to show will trend and be like number one. As they put that on the main screen for the most people, and they will get eyeballs on that show, whatever it is. So Netflix does have power here. I still own Roku. It's just hard for me to pull the trigger on Netflix. And we are seeing APAC's still weak. We are seeing slow ARPU growth in LATAM. Relatively flat, I'd say, ARPU in UCAN and EMEA. So I need to do some work here on price takes. Union Pacific, we talked about CN and rail with the transportations being weak. It's the same thing on the rail and Union Pacific. Again, they're all taking price, so it's not the end of the world, right? You can see this only down 3% year over year. But you can see in terms of certain places, like coal still very weak, force is very weak, intermodal again getting smashed. So in terms of revenue, it's down quite a bit. It's just that they're able to take enough price to offset most of it. So again, you're still down year over year. It's not like things are improving in rail. It's just they're slowing. They're just not as bad as, say, a trucking, where it's putting huge double-digit declines across revenue on operating income, right? Whereas the rails are able to just really still take price. Whatever seems to happen, rails take price. If that's the takeaway from this video, when I watch it next time, it's going to be that one. What else? Another transport company, Knight-Swift, down 67% year over year in adjusted EPS. This is on the trucking side. Intermodal's just getting destroyed. What else is that? Depressed truck freight load, where rate expectations from shippers are often close to or not below operating cost. You can tell that spot rates at this level are not sustainable levels. There's a thing saying out that spot levels are back down to 2019 levels, and that's interesting because the cost per mile is 30% higher than it was in 2019 because of wages and maintenance. So it's just like basically the business as it is right now, where rates are, it's not sustainable. And all we've seen since then is the spot rates actually held up, hasn't gotten worse. The contract rates have gone down to the spot rate for trucking, so things are still not good. I'd say the rate of changes means it's not getting worse, but it's not getting better, and we're actually seeing contract rates keep going down, which means for contractors it will still get worse over time, and better for everyone else, the retailers and the consumers on that point. Basically, there's just too much capacity still in trucking. Spotify, I think I still own this one. It's basically a business that just keeps growing in users, but they're finally, and this is the reason why I bought it, is one, it was getting cheaper, and then two, they finally raised prices like everybody else. This is the first price take they did, and the scale there is obvious when you have 500 million users, and you finally take price the first time in your operating life. It's just an easy one to build on, and I think Audible books and podcasts are both going to be a value unlocks for them over time as well, and further enhance the user experience as well as the margin profile as they get them profitable as well. Google, I also own that one. I don't know if I done a video on it or not, but advertising revenue, we've seen a kind of that divergence. So we've seen really good numbers in digital advertising for Meta, which I also own, in Google, but we've seen very bad numbers in legacy linear advertising, and that's been very interesting. So we've seen basically people cut their budgets for advertising, but basically the remaining budget they're shifting basically to the higher ROI areas, which is digital, because you could target it, so it technically should have better ROIs. This will only improve with AI over time as well, just matching ads to people. That's still happening. Microsoft is interesting. Unfortunately, I don't own it. Basically here you just have Copilot, which is an easy upsell. They claim it increases developer productivity by 55%, and they already have 40% of the biggest companies on pre-release. I have right here, live November 1st, 2023 should be an easy Copilot upsell. I use Excel for almost everything. So I will be definitely getting that as well when I can. Matt, I already talked about digital intelligence doing so well. They're still burning quite a bit of cash into Realty Labs. And you're seeing a good scale as well on the expense line. They've been pulling costs this entire year. And it shows pretty much every quarter so far. Royal Caribbean, like Carnival, just strong numbers. Booked load, very high. Booking level still very high. On the Amazon side, just doing well overall. What's supposed to happen here is CapEx supposed to be lower year over year. They've made changes from being a single national fulfillment to having 8 distinct regions. Basically, time to the last travel distance should be shorter, should increase ability to ship and also lower costs. So get that same day delivery at a cheaper price for the end user, or cheaper cost for Amazon. And we're also seeing AWS keep doing well. They're using their Graviton chips over x86 processors at Intel. They claim they're seeing 40% better price performance. Intel, they're claiming the PC business is finally stabilizing. They've been saying that for a while. It might actually be true now. But again, the data center is still very weak. The cloud guys have obviously shifted to NVIDIA. We've seen their sales go up about $10 billion year over year on the data center side. Basically all the CSPs, the cloud service providers, they've basically switched to NVIDIA products for accelerated computing. So all the CapEx has been going to NVIDIA. Skechers is actually doing okay. We're seeing, again, similar trend. We're seeing wholesale do weak and then the DTC business doing okay. DTC business is higher margin as well. So again, if your inventory is in hand, you should be pushing the DTC business. That's what we're seeing there. McDonald's, they mentioned traffic in the quarter was down for the low income consumer, as defined as 45K or lower. That was interesting because previously we were just seeing them slowly take share from other QSRs. And now we're finally seeing the people does not show up at all. And they also mentioned they're starting to see competitors promoting more. Here's Chorus. Chorus did a 15% work reduction, up from 8% just a quarter ago. They cut the dividend. They did pay down more than their entire market cap, EV market cap rather, in debt over the last 5 years. Anyway, they blame macroeconomic uncertainty as well as impact of extended writers and actor strikes at the time of this writing. It wasn't done or resolved yet. And the prior year was very bad for TV, so they're guiding down another 15 to 20% year over year. So very harsh declines in advertising for TV. Basically, they're guiding more of the same weakness that they just saw for a year. Spirit, they're also seeing softer demand. Again, Spirit's more of a domestic carrier with basically flights from Florida to the Caribbean. And just overall, this disappointing outcome. They're seeing the pilot pressures and the fuel pressures as well. We'll have to see how that merger with JetBlue goes. JetBlue is doing everything they can to actually make the merger happen. So we'll see if that happens. Air Canada, pretty interesting. Getting very cheap, 3 times EV, even over less now. Again, they say stable demand environment. And they actually expect to come at the high end of the guidance range. So a little bit different than the American ones. A part of that is Air Canada has a decent international business, which is still stabilizing. And as China slowly comes back online, Air Canada will actually start doing better because there's a decent amount of travel between China and Canada. Denny's, similar trend in the industry. Same store traffic levels softened during the quarter. Consumer customers declined. I just want to write because of that. LOL. Just me. I'm like, yeah, I'm thinking in my head, yeah, the geopolitical environments make me not want to go to Denny's. But anyway, what else is there? They believe casuals trading down to us. So casual dining, so that'd be like your sit-in diners are trading down to a Denny's, but they also believe they're losing share to the QSRs, the quick service providers. That's kind of a fun one. JetBlue, several challenges. They won down the NE Alliance, which also hurt their profitability for the quarter. Again, that's to try to get the Spirit buying them out and taking them over. All right, and then we have Estee Lauder on the beauty side. Net sales down 10% over year over year. They're saying 2024 will be challenging year as well. And they mentioned Asia travel was actually pretty weak and does appear to be still down about 50% versus 2019 levels for the APAC region out of China anyway. So I think it's approaching 70% now. Anyway, Norwegian, again, like the other cruise lines, still solid booking conditions. They took down guidance because Israel at the time of this reporting. Now we're finally back into November. What else is there? PayPal, I already talked about how they're not growing as well. I'm trying to check out, only up 8% July. You gotta remember the Braintree, the lower margin business is growing like 30% year over year. So when you have something growing 30% and your core business growing 8%, your margin's just going to slowly trade down with the sales mix as the lower margin product outgrows your branded. CVS, we talked about pharmacies enough already. They're feeling pressure. CVS here is reporting that their pharmacy and consumer wellness business put negative year-over-year adjusted operating income from pharmacy pressure and more generics, less COVID test kits. You can see this here, just not negative, just going down 12 million year-over-year. That's the trend now. It's down. You're down 748 million year over year in 9 months for CVS. Roku, we're seeing video advertising do well. Again, it's the digital advertising doing well with the linear doing weak. Originally, I was hoping that the linear would pick up with the digital, but that has not happened at all. What else is there? Technically, Roku is now profitable in terms of EBITDA, adjusted EBITDA, I should say. Jax is putting up some good numbers. I mentioned they have less promotions and some improved product margins as well as a better supply chain. I thought Halloween was soft overall. There's an activity in retail still in the US. But again, they're putting up crazy good numbers and their debt profile is now immaculate finally. What else is there? Airbnb is still putting up record travel. We were talking about travel still okay. But they are expecting the growth rate to moderate and they're seeing the ADR just to be stable to slightly up. So the average daily room rate, though they are expecting the take rate to expand. Paramount, we mentioned linear TV advertising is still down. Really weak. It was down 14% year over year, and that's into a year last year that wasn't very good either. So you have a very I want to say 6 quarters now of weakness at Paramount. But you are seeing, interesting enough, you're seeing advertising go up 18% on the digital side. So you're seeing their core business, their cash cow, go down 14, but you're seeing their advertising on their DTC go up 18. Both sub growth also went up 46%. So we are seeing the business start to stabilize on the direct-to-consumer side at Paramount. You can see the losses here go from 343 million negative to 238 million negative. And a large part of that is this subscription. And part of that is also they raised prices during the quarter. So we should see a further impact next year. Crocs is interesting. I also mentioned the challenging environment. In September, the trend softened across the industry. Footwear industry, and we're seeing consumers pull back in between peak shopping events. For Apple, we saw Mac revenue down 34% year over year. The product side of Apple has been relatively weak the whole year, really. Part of that is FX, obviously, but a part of that is just macroeconomic conditions have worsened. And a good thing for Apple, though, is that they made it up with the service growth as well as earnings per share buyback, so financial engineering. But anyway, Cinemark, we're seeing interesting dynamic happen. So you had the Oppenheimer thing and with Barbie did very well in July and August. We'll just see what happens. Basically, movies are it's kind of bipolar. You're either doing very well or you're doing very weak, and you don't know until the movies hit. All right, you know which one's going to be Indiana Jones or a Flash versus Oppenheimer or Avatar or Super Mario. The movie industry is very business. I own IMAX and Cineplex still. But largely just IMAX now. Uber's still putting up results. I wasn't expecting them to keep growing as high as they are, but they're actually up 30% year over year, and that's against the hard summer reopening comp of last year. So whatever Uber is doing, it's working, and they're doing it well. So I still own this one. I'm riding it out. It's just slightly more expensive than it was when they IPO'd, but the business is way better than it was when it IPO'd. The delivery business wasn't even there. And the advertising business is improving the margins for delivery. What else? WDD. I thought that was interesting. Zaslav says that they're they'll be below 4 times net levered by the end of the fourth quarter. But they have 45 billion in debt and they do not do 9 billion in EBITDA. They might do 5. So I think they're 9 times levered, but that's just me. What do I know? Advertising still down 12% year over year. Again, very similar to Paramount. You're just seeing a very bad advertising environment right now. Again, recessionary numbers in advertising for linear. And Disney, the same thing. You're having linear down 9% year over year. So not quite as bad as Discovery or Paramount, but still pretty bad. One of the interesting things, though, is that we've seen continued growth in the sub number at Paramount, while we've seen actual declines consistently now for more than 3 quarters at WBD. and Walt Disney. Part of that is because they juiced the numbers to begin with, which I think I called out when I did Disney a long time ago. Twilio's been interesting. This was kind of disappointing to me that they hired a new person and fired a new person pretty quick. They're supposed to be trying to break into AI on the Engage and Segment platform, and so far they've been having very little traction doing that. Their core business is communication, still doing quite well and growing quite well, and the profitability profile of the business has improved. They have been cutting cost, so we'll have to see if they are able to make that turn into what I think they can become. It's still speculative at this time if they can actually do it. Diageo just very weak, like we saw with LVMH on the Hennessy side. Luxury spirits, we've seen just continued weakness as well. Diageo's strategy has been going up premium, so as premium got weaker, Diageo sees it more. Their LATAM, they blamed it on a bunch of things in their investor day, but basically they said they don't have the same visibility in Latin as they do in the more modern markets. Part of it is also hard comp from last year. They had a bunch of reasons why their numbers were so bad in LATAM, and a few reasons why they didn't see it coming ahead of time. Anyway, we're seeing 20% less growth year over year in Latin America for spirits for Diageo, which isn't a bullish sign. For Capri, you're seeing macroeconomic headwinds as well as e-commerce implementation. I did own Capri, I'm pretty sure I did a video on it. But anyway, basically Capri's getting taken out by the other one, Tapestry. And so we'll have to see what happens. Anyway, I'm out of it now anyway, just because it took money to run to other things that were selling off. Cineplex, highest EBITDA quarter ever in the company's history. Again, it's 75% cheaper than any other time in its history. Part of that is the convertible debts they had to take on during COVID. But a part of it is also just the discount. The market doesn't think the box office will ever recover. Maybe it doesn't, but right now it doesn't need to because they're already putting up the highest numbers they've ever have. So that's kind of interesting. Film was only 90% of 2019 levels in terms of attendance, but it put up 135% of adjusted EBITDA of 2019 levels. A part of that is them taking price. A part of that is cost cutting. Anyway, what else is there? And we are starting to see the Apples and Amazon start to make videos for theaters. So the plan's coming out soon. That should be interesting to see how that does. And again, the idea, my idea with theaters is that basically it's a tentpole for the advertising their online streaming. So it gets a bunch of buzz, gets people out to see the movie, and then hopefully brings the eyeballs to their online streaming platform after the fact. That's the idea. So it's almost like theaters are a way of marketing expense for your online platform. That's how I view it in my head. Home Depot still very weak, 10% EPS down year over year. It continues to see pressure in big ticket categories. Framing lumber was down 20% year over year. Big transactions over $1,000 were down 5.2% year over year. Softer flooring, countertops, and cabinets. But you had strength in roofing, insulation, and portable power. Same stores, the Target still declining. They saw a 19% reduction in discretionary inventory, so they're handling the reduction or the slowdown in sales pretty well. They actually put up operating income that was higher year over year. They no longer had a discount to move the inventory because the inventory is in hand. So they actually targeted a very good job this quarter in managing a sales slowdown rate, 4%. Yes, less than revenue, but you cut COGS by 8%. So very good business here. Whatever they did over the year has been very good for them. They also mentioned consumers are delaying spending until the last moment. Demand has been down 2 to 4% recent quarters. Again, a recessionary indicator that people are buying less. This is how bad apparel has been. Apparel only declined high single digits. And then hardlines are still down low teens year over year. And then that's me kind of being like, could be an interesting idea. Could approach $10 at some point, so $100 only 10 times. We'll have to see. I'm able to spend some more time on Target. Could be interesting. When TGX continues to just do well, basically how companies manage inventory is sometimes they'll just get rid of it to TGX. TGX basically just buys it and resells it. So buys it at a discount and resells it. And allows the Targets of the world to get rid of their inventory. It's the margin, but it allows them to get rid of it. And then TGX can take that margin hit and make the margin for themselves as they sell it to people who come in for those wild card gifts. Cisco's still, I'd say this is interesting. So they had a good quarter itself, but again, Cisco has backlog. So they said basically the next 2 quarters, or 1 quarter at least, 1 to 2 quarters, it's going to be weak. So this quarter was fine. Next 2 quarters will be bad. They have an interesting thing on the data center side. So they basically miss cloud computing, Cisco. But they're starting to say, because of their Ethernet capabilities, they're finally getting back into the data center side for accelerated computing. Now they're competing with Nvidia's InfiniBand. But anyway, they have 500 million in sales at the last quarter, and they increased that to now $1 billion in sales. Cisco makes about 55 billion, 56 billion a year, so it's not a small amount. Well, it is small relative to Cisco, but it's starting to get bigger in a place where they've never been before. So Cisco could also be an interesting one to look at some point. Children's Place, I just did a video on this one. It did kind of as I wanted, so I picked up quite a bit of it. It's almost a full-size position now. It shot back pretty quickly after it went down, though. It was like 2 days down and started going up. It rejected the price. Here's Children's Place. Yeah, there it is. Yeah, I think when I did the video, I had about $4,000 in it. Now I have 9.3. No increase that as it gets cheaper, hopefully. That was an interesting one. Anyway, Children's Place was an interesting one. You had sales in terms of e-commerce do well, but they couldn't match the velocity of the sales on the e-commerce side to actually without incurring either third-party contracting or overtime rather. We'll have to see what happens. It's a weird problem to have, as a lot of the other retailers are seeing sales declines year over year, but you actually had e-commerce become 57% of sales this quarter for Children's Place. So they did, technically the thesis is working. It's just the amount of pain that they had to try to deliver all the orders that were coming through e-commerce in the quarter hurt the quarter. Again, this should go away next year, which should be very interesting in terms of comps. But anyway, it's a weird problem to have. Whereas I'm seeing all the other realtors or retailers rather sell off. Walmart's doing very interesting as well. So you have groceries and health and wellness doing very well, but then you have general merch suffering. It's really the main thing there. You are seeing here, you see growth in private brand penetration, another 20 bips. That's been a trend for more than a year now. Walmart's basically taking share as people trade down to cheaper things, and they're a great value platform. So not only is Walmart winning from people going to Walmart versus where they used to shop, but they're also within Walmart. They're buying the Walmart brand instead of the national brand, whatever it is, like a Kraft or pick your CPG company, Pepsi or Conagra would be a good one because that was probably one of the weaker ones. Dun dun dun. And here they're saying, Walmart's saying wage inflation's not as bad as it has been. Macy's store comps down almost 7% year over year. Sales were good in beauty, fragrances, cosmetics, and women's career sportswear, but they're weak in casual sportswear, big ticket handbags. Basically, inventory for a lot of these guys is now in control, right? So they're starting to see margins expand. It's just that sales are still declining. So they're starting to offset the year-over-year EPS decline, even though sales are still dropping with the cost savings through better inventory management. What else is there? Williams-Sonoma is down 14% year over year. Again, recessionary numbers. People buying fewer larger furniture pieces than last year. Consumer hesitancy on high-ticket discretionary furniture. So again, it's a very similar theme. Kind of having into this, but it's important to go through because you can see it all. Well, it's Gap down 15% year over year. Old Navy is only down 1%, so that helped average it out. They're only down 6% year over year, same store. They did cut Gap China and they shut down Yeezy Gap. So that's why Gap was down 15%. Same comparable stores were only down 6%. What else is there? That was kind of interesting. They did say recent November trends have modestly improved versus Q3, so I have to see if that's true. Well, I'm on the China domestic side. China's finally starting to report now. Domestic was 70% above 2019 levels, but outbound travel is only 50% recovered in terms of industry. So that's basically why I think Chinese people are staying in China and spending money, is that they don't want to go internationally for whatever reason. So we'll have to see if that changes or not, because that will affect quite a few things. What else is there? Tunia basically saying the same thing. Well, they claim as outbound destinations gradually open up, we are further expanding our supply chain and product offerings to meet demand. One of the reasons why they view that international is not recovered yet is because the travel resources are not yet fully restored. So basically it tells me that they don't have international, as many international flights as they had pre-COVID set up yet, and they've been slow to get back to it. And part of that is probably because it's centrally planned. Or maybe because it's centrally planned, they're actually making it less a priority because they want the Chinese consumer to spend in China on Chinese things. That could also be it, right? To try to keep the Chinese economy going. Anyway, Kohl's, also in this one, September, October, had impact on demand from fall seasonal goods in store. They claim some of it's weak from weather. The same beauty sales growth accelerated in the quarter, so Sephora is working. To take off the bottom of the guide, 40% of Sephora baskets have additional Kohl's products purchased in the basket. Credit losses are moving up, so we're starting to see more credit provisions, less credit card lending income, a bunch of stuff happening. Lowe's, very similar to Home Depot, but probably worse. You have comparable sales down 7.4% year over year. They also mentioned you do it yourself discretionary spending. They also mentioned weaker and bigger ticket categories. Best Buy, same thing. They decided to take down the revenue guide for the year. They expect comparable sales to decline 3 to 7% in Q4. And additionally, indicators have continued to soften, including declining consumer confidence, increased debt, and waning savings. Abercrombie is actually the opposite. They're doing something, they're marketing aggressively on TikTok, and they're also making dupe products, just basically cheaper knockoff products of successful brands. So one would be Aritzia. Basically, they're just taking Aritzia's brand, product offerings, making a cheaper version of it and selling it, and using TikTok to go viral with its user base. NVIDIA, you can see the growth here is just shot up from 3.8 billion to 14 billion latest quarter. That's in data center, and that is the CSPs. They actually say 50% of that growth, 50% of the 279% year-over growth is cloud service providers, and of the three, it would be Google, Microsoft, and Amazon. So pretty staggering growth rate, and how much this influences both revenue growth rate as well as margins. So whenever the cloud service providers digest this inventory, we might actually see NVIDIA decel. It's not what I'm calling for, but that's what I might consider getting into it. That's just my personal take. We'll have to see how that actually plays out or not. But it does show a high amount of growth being driven by those big three cloud providers. Guess, believe the customers are looking for value, promoting accordingly. Europe stays strong, but America retail is weak. America observed contractions in all major categories, including women's and men's apparel, accessories. Nordstrom credit card delinquencies are rising, but within their expectations. They got in for revenue to be down 4 to 6, with 2.5% due to shutting down Canadian operations. So some of the retailers are already seeing more reaction, like we're finally seeing banks cut headcount. Retailers have been cutting headcount for a while and trying to reduce whether it's weaker store areas or weaker geographies like Canada for Nordstrom. Anyway, Claire is still at EPS up 20% year over year. I still own that one. I'm pretty sure I did a video on it. Even with same store sales down 5%. They did specifically say that they weakened Boots. What else? And then Deere was yesterday. So anyway, today is November 23rd. It's been a long video. Anyway, Deere guidance was also weak. They got into global forestry sales down 10%. And basically construction down 5 to 10, and they're also seeing pressure on their finance arm. So a lot of pressure out there. You can see here the global manufacturing outlook still deteriorating year over year. So this is your PMI for most of the developed world. It's well below 50 now for most of them, and it didn't get better after the time of this writing or when they were showing this. So most manufacturing is pretty much in a recession, and goods are pretty much in a recession. It's just the service side and the travel side that's still putting up growth year over year. And that was pretty evident when we ran through all those numbers, right? You were getting the themes. Here you have Canadian GDP again. Basically, they're estimating it to be very weak in terms of real per capita. So because Canada's immigrated in so many people, we're actually seeing GDP measured by consumption still increase because more people will be consuming. So that's actually helping keep the Canadian economy from going in a recession. But if you were to take out the immigration and take out the inflation in the consumption number, you would actually be in a recession now for quite some time, at the time of this video anyway. So the market could be front running that because we were seeing a lot of good deals in Canada in October. Doesn't mean we'll see them again in March or February or something like that, but usually markets are forward looking. So we have started seeing rates, at least more people start to believe that rates have peaked, and so that's probably going to pick up steam as we go into the next year. More people go to that after the fact. Here's a fun one. So Bank of Canada basically saying 40% of people in Canada have felt the interest rate increases. That will go to 100% by 2026 if they keep rates as high, which they won't, according to me. But anyway, basically, you have 40% more people that are seeing pressure from higher rates, and every single week that they keep rates this high, you're going to get that number up more and more. And basically, a lot of Canadian mortgages reset for about 5 years on average, which basically means you have 5 years of consumption that's going to get hurt after the fact. So the longer they keep rates here, the more you're going to hurt consumption, not just 1 year, but you're going to hurt it for years after the fact. And so that's one of the reasons why I think, well, they'll talk a tough game just to keep inflation expectations anchored. They will eventually cave, and I don't know when they will, but it's going to be very obvious because things aren't exactly accelerating, at least in Canada. Anyway, hope you enjoyed this video, and have a great rest of your weekend.